Hello and welcome to our conversation on cost volume profit analysis. And we have seen in the previous presentation that the cost volume profit relationship in the short run depends on using this contribution to sales ratio, break-even sales, and by using this contribution to sales ratio we can find sales to earn profit, we can find break-even sales. So the contribution, which is the excess of sales over the variable cost, is a very useful number to be used in the CVP analysis, particularly in the short run. So contribution from break-even sales is fixed cost, because at a break-even sales there is no profit, no loss, so the contribution is just enough to recover the fixed cost. Contribution to earn profit is equal to fixed cost plus profit, and contribution for margin of safety. Margin of safety is excess of sales over the break-even sales. So by break-even sales you have recovered the fixed cost. So any contribution over the break-even sales or from the margin of safety is profit. Let us take an example to explain and understand this. So this information is given: selling price, variable cost, fixed cost, and actual profit. So let us find the contribution per unit. The contribution per unit is equal to S minus V. So the contribution per unit is S minus V. So contribution to sales ratio is 45 divided by sales. So that is contribution to sales ratio, which is also called contribution margin. Now with this information we can find the break-even sales, and the break-even sales is equal to fixed cost by contribution to sales ratio or by contribution margin. The fixed cost is 360,000 and the company desires profit, so therefore, or if actual profit is 120,000, then the sales to earn this profit is equal to the fixed cost plus profit divided by the CSR. Fixed cost plus profit by CSR. In case of break-even, it is fixed cost by CSR. So actual sales in order to earn profit is equal to 520,000. So when we make a sales of 520,000, we get contribution which is equal to F plus P. Let us find the margin of safety. Margin of safety is actual sales minus the break-even sales. So actual sales minus the break-even sales. Actual sales is 520 and break-even sales is 360. So actual sales minus the break-even sales, which is MOS, is equal to 160,000. But the margin of safety can also be calculated as profit by CSR, so which is equal to, so at this moment we want to make a profit, or we made a profit of 120,000, and so therefore in order to make this much of profit, our margin of safety, that is excess of sales over the break-even sales, is 160,000, which is profit divided by the CSR, which is 75%. So to recap, we'll say that the contribution from the break-even point, contribution from break-even point is equal to fixed cost, which is equal to 75% of 75% of the break-even sales. So 270,000. How did we get this? This is 75% of the, so CSR into break-even will give me contribution from break-even sales is equal to fixed cost. So let us find contribution from the actual sales is equal to fixed cost plus profit, is equal to fixed cost plus profit, and that is being calculated as the CSR into actual sales, which is equal to fixed cost plus profit. The contribution from the margin of safety, contribution from margin of safety is equal to 120,000. So contribution from the margin of safety is 75% of the margin of safety is 160,000. So the very purpose of this particular exercise is to show the interrelationship between sales, the variable cost, that is cost, okay, particularly the variable cost, then volume, profit, okay, so volume and profit. So these three are interrelated and interdependent. So in the short run, because the fixed cost is constant, we manage profit by managing contribution, and we manage contribution by managing the volume of the goods sold. Thank you very much.